Two co-workers, same company, same salary. Both started investing for retirement in 2000. Both contributed the exact same amount every year for 24 years. One has $900,000 in there for 401k, the other has $650,000. $250,000 difference. What happened? Not luck, not better stock picks, not market timing. 1.03%. A fee difference of 1.03%. Over 24 years, that 1% didn't cost him 1%. It cost him 28% of his retirement. His name was David, age 52. He had no idea. For 24 years, he thought he was doing everything right. Contributing consistently, staying invested, not panicking. And he still lost $250,000 to fees he didn't understand. This is happening right now to millions of Americans. Average for 101k fees, 1.54%. Over a 40-year career, that doesn't take 1.54%. It takes 38%, more than a third of your retirement. Gone. I'm John. I spent 6 months analyzing fee structures from 83 retirement fund providers and interviewed 41 people who discovered they'd been paying high fees for years. What I found isn't accidental. The fee system is intentionally designed to be invisible, confusing, and impossible to compare. Today I'm showing you how the 1% fee actually works exponentially against you. The 5 ways the industry hides these fees. And the 3 steps to protect yourself starting today. Because here's what David didn't know. That 1% isn't 1% of your contributions, it's 1% of your total balance. Every single year, forever, as your balance grows to hundreds of thousands, that 1% becomes thousands of dollars, and it compounds against you. Those dollars never get to compound for you. They compound for the fund company instead. Your money tree gets branches cut off every year that could have grown into retirement wealth. The financial services industry made $92 billion in investment fees last year, transferred from retirement savers like you to fund companies. Most people have no idea how much they personally contributed. Let's fix that. David was hired as an accountant in 2000, age 28. Salary, $58,000. His company offered a 401k with 4% match. He contributed 6%, 10% total. Model behavior. His 401k offered 12 funds. He picked what sounded professional, American Growth Fund, managed by experienced portfolio managers since 1987. Expense ratio, 1.25%. He saw that number but had no idea what it meant. Here's what it meant. 1.25% of his total balance disappeared every year, automatically, invisibly. He never saw it leave. It just vanished from his returns before he even saw them. Year 1, contributed $5,800. Market returned 8%. Balance should have been $6,264. Actual balance, $6,192. $72 disappeared. His statement never showed a line item for fees, just the final number. Year 5, balance was $38,100. In a low-cost fund charging 0.04%, $40,300. $2,200 more already. The gap was growing. Year 10, gap was $7,200. Year 20, $33,000. More than half a year's salary lost. And David still didn't know because fees were never itemized. David got promoted over the years. Salary grew to $92,000. He increased contributions. Stayed disciplined, never panicked. Did everything the experts say and the gap kept widening. Year 24, 2024, David is 52. High fee balance, $648,000. Low cost alternative, $900 to $1,000. Difference, $254,000. That's not a fee, that's a house down payment. 4 years of retirement, his daughter's college twice over. David thought he was being responsible. Professionally managed fund, stay invested, don't chase trends. He followed all the rules and lost $250,000 anyway because the rules were designed by people collecting the fees. He discovered the truth in 2023. A coworker mentioned she'd switched to index funds years ago. 0.04% fees instead of over 1%. Saves a fortune. David went home and actually read his statement. Really read it, for the first time in 23 years. Expense ratio, 1.25%. Plus administrative fees, 0.4%. Plus record keeping, 0.15%. Total, 1.8%. He Googled for 401k fee calculator. Entered his numbers. 648,000 balance at 1.8%. Annual fee, $11,664. Every year, forever, he felt sick. 11,600 per year wasn't abstract. It was real. It was his family vacation. It was a new car every year. Taken, forever, until he changed it. The fee hiding system has 5 specific methods designed to keep you from noticing. Method 1. Percentages instead of dollars. 1.8% sounds small. But they never say you paid $11,664 this year. Why? Because percentages hide scale. 1.25% of 6,000 is $72. 1.25% of 600,000 is 7,500. Same percentage, 60 times more actual money. You only see the percentage. Method 2. Confusing terminology. Expense ratio sounds technical, administrative, necessary. It doesn't sound like the fee we charge to manage your money forever. 68% of 401k participants can't even define expense ratio. Method 3. Invisible deduction. The fee never appears as a transaction. You never write a check. You never see a withdrawal. Market returns 8%. They take 1.8. You see 6.2. The fee is subtracted before you ever see it. David's statement said your account earned 6.7%. What they didn't say, market returned 8.5. We took 1.8. You got 6.7. The theft was hidden in the math. Method 4. Fee layering with different names. Expense ratio in the fund prospectus. Administrative fee in the plan document. Record-keeping fee in a separate disclosure, each small, combined, massive. But you have to hunt through 3 documents to find the total. Method 5. Comparison impossibility. Fund A. Total operating expenses 1.25%. Fund B. Net expense ratio after waivers 0.68%. Fund C. Management fee 0.75 plus other expenses. Which is cheapest? You'd need a translator. A 2019 study found funds with higher fees used more complex disclosures. Deliberately. The worse the deal, the harder they make it to understand. This is designed. Now here's why 1% is exponentially more expensive than it sounds. It's not just the fee itself. It's what that fee prevents from compounding. Every dollar paid in fees never compounds for you. David paid $100 in fees year 1. He didn't just lose 100. He lost 100 plus 30 years of compound growth on that 100. At 10% growth, that's $1,745 of future wealth destroyed. Every fee dollar costs 17 times its face value in lost compound growth. That's why a 1% annual fee doesn't take 1% of your retirement. It takes 30 to 40% over a career. The compounding works against you. David's math, total contributions $168,000. At 0.04% fees, $900 to $1,000. At 1.8% fees, $648,000. Fee difference, 1.76%. Retirement difference, 28%. 1.76% doesn't sound like much. 28% of your retirement is everything. The percentage hides the reality. Why do funds charge these fees? Why the complexity? Follow the money. Average actively managed fund, 1.09%. Average index fund, 0.06%. On a $1 trillion industry, that 1% difference is $10 billion in annual fees. They profit when you pay more. Here's what they don't tell you. Higher fees don't mean better returns. Morningstar studied 20 years of fund performance. Finding, the cheapest funds outperformed the most expensive in every single category. Lower fees predicted higher returns better than any other factor. You're paying more to get less. David's American Growth Fund managed by professionals. Return 6.8% after fees over 20 years. S&P 500 Index, 9.8%. He paid higher fees for 3% lower returns. Double penalty. The investment management industry made $92 billion in fees last year. Every dollar of industry profit came from someone's retirement account. The average fund manager makes $400,000 to $2 million per year. The average American retires with $215,000 total. Your 1% fee doesn't go to operating costs. It goes to executive compensation, marketing budgets, shareholder profits. You're paying for their wealth, not yours. Vanguard is structured differently. Owned by its funds, which are owned by investors. You, no outside shareholders extracting profit. That's why their fees are 94% lower than industry average. Most funds are owned by public shareholders or private equity. Their goal: maximize profit from you. Your goal: maximize retirement wealth. You're on opposite sides of the table. That's why they hide fees. Why they use percentages, not dollars. Why comparison is impossible. Because if you understood the total cost, you'd leave, and they'd lose billions. Nobel Prize economist William Sharpe: the average actively managed dollar must underperform the average passively managed dollar after costs. It's arithmetic, not opinion. The system isn't broken. It's working perfectly, just not for you. What did David do when he discovered he'd lost $254,000? And what can you do today? 3 steps. Step 1. Find your actual dollar cost. Not percentage. Dollars. Log into your 401k, find your balance. Find the expense ratio for each fund. Multiply balance times expense ratio. That's your annual fee in dollars. Example: $200,000 balance at 1.2%. 200,000 times 0.012 equals $2,400 per year. That's your fee, every year, until you change it. David calculated his. $648,000 at 1.8% equals $11,664 per year. That visceral dollar amount made him act. Percentages are abstract, dollars are real. Step 2. Switch to low-cost index funds immediately. The difference between 1.8 and 0.04% is $11,400 per year saved on David's balance. Look for expense ratio below 0.1%, passive index funds. Total market or S&P 500, Vanguard, Fidelity, or Schwab. Specific funds: Vanguard total stock market, 0.04%. Fidelity 500 index, 0.015%. Schwab S&P 500, 0.02%. All 95% cheaper than David's old fund. David moved all $648,000 to Vanguard total stock market. New annual fee, $259. Down from $11,664. Annual savings, $11,405. Over his next 15 working years compounded at 8%, $387,000 saved. He can't recover the past $254,000. That's gone. But he protected $387,000 in future wealth. Past regret, future action. You can do the same today. Step 3. Annual fee audit. Set a calendar reminder. Check fees every January. 10 minutes. Fees can change. New lower cost options appear. Protect what you've built. What about financial advisors charging 1% to manage your account? On $500,000, that's $5,000 per year. For that to be worth it, they must add more than $5,000 in value through better returns, tax strategy, or behavioral coaching. Studies show most advisors don't beat low-cost index funds after fees. Vanguard found advisors at about 3% lifetime value, mostly from behavioral coaching, not stock picking. If you're disciplined, you probably don't need 1% ongoing fees. Consider fee-only planners instead. Fee-only planners charge flat rates, $500 to $3,000 for a comprehensive plan. One time, not 1% forever. David paid $1,500 for a retirement roadmap. Confirmed his low-cost index strategy. One-time cost, lifetime value. Target date retirement funds, convenient but check fees. Some charge over 1%, others under 0.2. Same concept, massive fee difference. Vanguard Target 2050, 0.08%. American Funds 2050, 0.71%. 9 times more expensive for identical service. If your 401k only offers high-fee funds, 3 options. Lobby HR to add low-cost options. Contribute enough for the match, then use a separate IRA for additional savings. Or accept the fee as the price of the match. Many employees successfully lobbied for better options. You'd help everyone. Don't let tax loss harvesting justify high fees. Robo-advisors provide automated tax loss harvesting for 0.5%. You don't need 1% for that. When David told his old advisor he was switching to index funds, the advisor had 3 objections. You'll hear them too. Objection 1. Index funds are risky. Our managers protect you in downturns by moving to cash. Reality: 92% of active funds underperform over 15 years. They can't time the market. During 2008, average active large cap fund fell 38%. S&P 500 fell 37%. Active failed to protect and charged more. Objection 2. You get what you pay for. Higher fees reflect higher quality. Reality, the opposite. Morningstar found fees are the single best predictor of returns. Lower fees predict higher returns. Not research quality, not expertise. Fees. Objection 3. Index funds only match the market. We aim to beat it. They aim, they fail. 95% fail to beat their benchmark over 20 years after fees. Aiming and achieving are different. Matching the market through low-cost index funds means you beat 95% of active investors. Because most investors pay fees that drag them below market returns. David's advisor ended with good luck with that. 2 years later, David's index portfolio up 18%. Old fund up 14%. Low-cost won again. Don't let sales tactics disguised as advice scare you. The data is overwhelming. Lower fees win. Nobel laureate Eugene Fama. Your money is like soap. The more you handle it, the less you have. Low-cost index funds handle your money less. You keep more. What does this fee difference mean for actual retirement life? Meet Amy and Beth. Both age 30 in 2024. Both earn $70,000. Both save 10% for 35 years. Both get 8% returns before fees. Only difference, fees. Amy's 401k, 0.1% fees. Beth's 401k, 1.4% fees, 1.3% difference. Age 65, 2059. Amy's balance, $1,238,000. Beth's balance, $814,000. Difference, $424,000 from 1.3% fee difference. Using 4% safe withdrawal, Amy withdraws $49,500 per year. Beth withdraws $32,500. Difference, $17,000 per year, every year, for life. That $17,000 is 3 months living expenses. 2 international trips yearly, healthcare costs. Helping grandchildren with college. The difference between comfortable and tight. Beth worked the same years. Saved the same percentage. Made the same sacrifices. $17,000 less per year because her employer chose expensive funds. Structural disadvantage. This is why fees matter. Not because 1% sounds big. Because 1% compounds into massive lifestyle differences in retirement. On a $400,000 balance at retirement, the difference between 0.1 and 1.4% is $5,200 per year. Every year, forever. That's not trivial. That's your retirement lifestyle. The financial industry wants you to think in percentages because percentages hide reality. Think in dollars. Calculate dollars. Protect dollars. Your retirement isn't a percentage. It's a life. And 1% fees are quietly stealing that life from you. David lost $254,000 to fees over 24 years. That's unrecoverable. But by switching to low-cost index funds, he's saving $11,400 per year. Over 15 years, that compounds to $387,000. He can't fix yesterday, but he fixed tomorrow. You can do the same, today. Log into your 401k, check your fees, calculate the dollar cost. Switch to the lowest cost index funds available, 15 minutes. Could save you $250,000 or more. The 1% fee isn't 1%. It's 28 to 38% of your lifetime retirement wealth. It's $400,000 stolen from someone saving 40 years. It's the difference between comfortable and struggling. And it's completely avoidable. Choose low-cost index funds. Reject fees above 0.2%. Protect your future, because the fund companies won't. If this exposed how fees quietly destroy retirement wealth, subscribe to Wealth Insider Lab. Every week I break down financial industry systems designed to extract your wealth and show you exactly how to protect yourself. Because they're counting on you not understanding the math. Now you do.